The world woke up to a new reality on January 1st, 2026. China, the giant of global metal production, flipped a switch that could shake the entire silver market. This was not a complete ban. It was something more subtle but equally powerful. China announced that companies wanting to export silver must now get special licenses. This change affects a metal that most people barely think about. But silver runs through the veins of modern life. China supplies between 60 and 70% of the silver that flows into the global market. Think about that for a moment. More than half of the world's traded silver comes from one country. When that country decides to control who can sell silver abroad, the impact spreads everywhere. The new rules came from China's Ministry of Commerce in late October 2025. They established what experts call a state trading management system. The system will stay in place through 2026 and 2027. The rules are strict. Only large companies that produce at least 80 tons of silver per year can even apply for an export license. This requirement immediately cuts out smaller producers and traders. The Chinese government gets to decide who qualifies and who does not. They control the tap. They can turn it down whenever they want. Why does this matter so much? Silver is not like gold. Gold sits in vaults as a store of wealth. Silver works for a living. It conducts electricity better than any other metal on Earth. It reflects light with incredible efficiency. It kills bacteria naturally. These properties make silver essential for the technology that powers modern society. Look at your smartphone. Silver is inside it. The circuits that carry signals through your device rely on silver's superior conductivity. Every solar panel converting sunlight into electricity contains silver paste. This paste forms the conductive pathways that make photovoltaic cells work. Electric vehicles use silver in their battery systems and charging components. Medical equipment depends on silver for both its electrical properties and its antimicrobial effects. The solar energy industry alone consumed nearly 200 million ounces of silver in 2024. That number keeps growing as the world pushes toward clean energy. Each solar panel needs about 0.64 ounces of silver. When you multiply that by the millions of panels being installed every year, the demand becomes staggering. The electronics industry used another 221 million ounces in 2023. Add in uses for brazing alloys, photography, jewelry, and investment, and you see why silver matters. Now imagine what happens when the biggest supplier suddenly puts restrictions on exports. The market was already tight before China's announcement. Very tight. The world has been consuming more silver than it produces for 5 years straight. That bears repeating. 5 consecutive years of deficits. The shortage in 2025 alone reached approximately 117 million ounces. That is one of the largest shortfalls in recent history. Think of it like a bathtub. Water flows in from the faucet, representing mine production and recycling. Water drains out, representing industrial use, investment demand, and jewelry making. For 5 years, the drain has been open wider than the faucet. The bathtub level keeps dropping. At some point, there's not enough water left to meet everyone's needs. Global silver demand in 2025 hit about 1.12 billion ounces. Mine production worldwide stays relatively flat at around 813 million ounces. Recycling adds more supply, but not nearly enough to close the gap. The Silver Institute, which tracks these numbers carefully, projects the deficit will continue into 2026. They estimate another shortfall of about 30 to 60 million ounces next year. China produces roughly 13% of the world's mined silver. That places China second among all nations, right behind Mexico. But here is the crucial difference. China does not export all the silver it mines. Much of China's silver comes as a byproduct from mining other metals like copper, lead, and zinc. The country uses a lot of silver domestically for its massive electronics manufacturing and solar panel production. That represents a gain of more than 120% in less than 12 months. By mid-December, silver touched record highs above $66 per ounce. This surge outpaced gold's impressive 64% rise during the same period. Silver became one of the best performing assets of 2025. What drove prices up so fast? Multiple factors converged at once. The supply deficit played a major role. When buyers want more of something than sellers can provide, prices rise. Simple economics. But other forces amplified the move. Interest rate expectations shifted as central banks, including the U.S. Federal Reserve, signaled potential rate cuts in 2026. Lower interest rates make precious metals more attractive because they reduce the opportunity cost of holding assets that do not pay interest. Investment demand surged. People who had ignored silver for years suddenly wanted to own it. Exchange-traded funds that hold physical silver saw massive inflows. Individual investors bought coins and bars. Large institutions added silver to their portfolios. When investment demand rises alongside industrial demand, the pressure on limited supplies intensifies. The artificial intelligence boom added another layer of demand. AI data centers require enormous amounts of electrical infrastructure. Every server, every cooling system, every power supply uses silver for connections and conductivity. The expansion of AI technology is happening at breakneck speed. This creates demand that did not exist a few years ago. China's export restrictions landed on a market already stretched thin. Analysts immediately recognize the implications. If China reduces the flow of refined silver to global markets, the deficit will deepen. Industries that depend on silver will face higher costs. Some might struggle to secure enough supply to maintain production. The solar panel industry faces a particular challenge. Solar energy represents one of the fastest growing sectors in the global economy. Governments worldwide have committed to expanding renewable energy. Solar installations are central to those plans, but if silver becomes scarce or too expensive, solar panel manufacturers face difficult choices. They can pass costs to customers, which might slow installations. They can try to reduce the amount of silver in each panel, which requires new technology. Or they can compete harder for limited supplies, which drives prices even higher. Electronics manufacturers confront similar dilemmas. Silver's unique properties make it difficult to substitute in many applications. Copper conducts electricity reasonably well and costs less. But copper cannot match silver's performance in critical applications. For smartphones, computers, automotive electronics, and precision instruments, silver often has no equal. When a manufacturer cannot get enough silver, production slows or stops. Some experts compare China's silver move to its earlier restrictions on rare earth elements. China dominates rare earth production and has used export controls as a strategic tool. By controlling access to materials that other countries need, China gains leverage in trade negotiations and geopolitical discussions. Silver might serve a similar purpose. The metal has both industrial importance and strategic value. The restrictions do not amount to a complete export ban. China will still export silver, but only through approved state trading companies that meet strict requirements. This gives Chinese authorities tremendous control. They can adjust the flow of exports based on domestic needs, foreign policy goals, or market conditions. The lack of transparency makes it harder for global buyers to plan and budget. Other countries cannot easily replace Chinese supply. Mining companies in Mexico, Peru, Chile, and other silver-producing nations already operate near capacity. Opening new mines takes years and requires massive investment. The permitting process alone can drag on for a decade in some jurisdictions. Even when prices rise dramatically, new supply does not appear overnight. Recycling offers some relief, but has limits. Silver gets recycled from old electronics, photographic materials, and industrial waste. However, recycling rates for silver remain relatively low compared to gold. Much of the silver used in electronics ends up in landfills. The tiny amounts in each device make recovery expensive and difficult. Recycling will increase as prices rise, but it cannot close a 117 million ounce annual deficit by itself. The situation creates what traders call a supply shock. Markets that operated in relative balance suddenly face a major disruption. Buyers, who assumed silver would always be available at reasonable prices, discover that assumption no longer holds. Panic buying can follow. Industries stockpile silver to ensure they have enough for future production. Investors buy. Some analysts predict silver might reach $75 per ounce or even higher. A few bold forecasters suggest silver could eventually hit $100 per ounce if the supply situation does not improve. These projections depend on many factors. Industrial demand must stay strong. Investment interest must continue. Mining production must remain flat or decline. And most importantly, China must maintain its export restrictions. The impact extends beyond just price. Companies throughout the supply chain face uncertainty. A solar panel manufacturer might secure a contract to deliver panels at a fixed price. But if silver costs surge after the contract is signed, the manufacturer loses money on every panel. This risk makes businesses hesitant to commit to long-term fixed-price agreements. Uncertainty slows investment and development. Smaller companies face the greatest challenges. Large corporations can afford to pay higher prices for silver. They have established relationships with suppliers. They can lock in supplies through long-term contracts. Small manufacturers and startups lack these advantages. When silver becomes scarce and expensive, smaller players get pushed out of the market. This concentration of power in the hands of large firms reduces competition and innovation over time. Consumers will ultimately feel the effects. Higher silver costs flow through to finished products. Solar panels become more expensive, potentially slowing the transition to renewable energy. Electronic devices cost more. Medical equipment prices rise. Jewelry gets pricier. While silver represents a small fraction of the cost in many products, significant price increases add up. The geopolitical dimension cannot be ignored. China's decision to restrict silver exports does not happen in isolation. Tensions between China and Western nations remain elevated. Trade disputes, technology competition, and strategic rivalries create a complex backdrop. Silver joins a growing list of critical materials where China exercises significant control. The list includes rare earths, certain types of steel, and various chemical precursors, countries that depend on Chinese silver exports face a strategic vulnerability. If China decides to reduce exports further for any reason, those countries must either pay higher prices or do without. This gives China leverage in negotiations on completely unrelated issues. The interdependence that globalization created now reveals its fragility when one nation controls critical supply chains. Some nations are responding by trying to diversify supply sources. The United States recently designated silver as a critical mineral, acknowledging its strategic importance. This designation can lead to government support for domestic mining and recycling. Other countries are making similar moves, but building alternative supply chains takes many years and enormous investment. The silver market is relatively small compared to oil, copper, or iron ore. Total annual silver production in value terms measures in the tens of billions of dollars, not hundreds of billions. This small size makes the market more volatile. Large buyers or sellers can move prices significantly. When a country controlling 60 to 70% of exports changes the rules, the entire market shifts. Silver investors are watching these developments closely. Some see the current situation as a historic buying opportunity. They believe supply constraints combined with growing demand will drive prices much higher over the next several years. Physical silver in the form of coins and bars has seen strong demand. Premiums over spot prices have widened as dealers struggle to source inventory. Others urge caution. They point out that high prices eventually bring more supply to market and reduce demand. Industries will invest in substitutes and more efficient technologies. Recycling will increase. New mines will open eventually. Speculative bubbles can burst quickly, leaving late buyers with losses. The silver market has experienced boom and bust cycles before. The truth likely lies somewhere in between these extremes. China's export restrictions represent a real constraint on supply. The global deficit is real. Growing industrial demand is real. These factors support higher prices. But markets have a way of adjusting over time. The adjustment process might be painful and take years, but it happens. For now, the world must deal with the reality that 15% or more of global silver supply faces restrictions starting January 1st, 2026. This figure comes from the fact that China controls 60 to 70% of exports, and about 20 to 25% of that